Every year, corporate finance departments brace for the exact same ritual, pulling long hours, sifting through mountains of paperwork to close out the year. This behavior is driven by a widespread assumption across the industry, the idea that audit preparation is an isolated 30-day sprint you run right before the auditors walk through the door. That sprint is fueled by a toxic operational mantra. Throughout the year, teams ignore minor discrepancies and undocumented entries, telling themselves they will simply fix everything when the auditor comes. When month 12 finally arrives, that delayed maintenance triggers a cascade of reactive behavior. Teams scramble to reconcile accounts that haven't been touched in 3 quarters, trying to force the numbers to match. This frantic cleanup leads directly to the creation of backdated reconciliations. Instead of documenting the actual flow of funds, staff reverse engineer ledgers just to make the final balances look correct on a spreadsheet. Treating the audit as a localized emergency misses the point of the exercise entirely. It assumes the auditor is there to grade your ability to cram for a test, rather than evaluate the integrity of the business itself. An audit report is not a reflection of how hard your finance team worked during that final month. It doesn't measure a 30-day sprint. The outcome of an audit is a lagging indicator. It measures your company's financial process maturity over the preceding 365 days. The standard approach relies on a chaotic surge of activity at year-end to compensate for dormant financial controls. A mature organization operates on continuous readiness. Workload is distributed evenly, requiring no sudden heroics, as data is maintained in real time. Relying on the sprint creates severe operational friction. It burns out the finance team with unpredictable hours and signals to external partners that the company's internal reporting is unreliable. More importantly, it creates massive financial risk. Forcing numbers at the last minute dramatically increases the likelihood of audit adjustments and heightens the risk of a qualified audit opinion. You cannot engineer a clean audit at the finish line. It is a natural, unavoidable byproduct of daily operational discipline. Because of that 30-day sprint mentality, there is a massive disconnect between what internal teams prepare and what the external auditors actually look for. Internal teams obsess over the final outputs. They spend their sprint ensuring every spreadsheet balances and every column ties out mathematically perfectly. Auditors are not there to check your final arithmetic. They are there to test the underlying system that produced those calculations. This is the evaluation of internal control design. It measures whether the structural rules governing your financial data are effective and consistently enforced. When auditors review revenue recognition, they aren't just looking at the total income. They evaluate the timing and classification accuracy of every transaction to prove the system categorizes money correctly over time. With cash and bank reconciliations, balancing the books on December 31st is irrelevant if you cannot provide evidence of daily, systematic transaction matching throughout the year. A flawless final report holds absolutely no weight if the procedural engine that generated it is compromised. The tipping point in any audit happens the moment the auditor's routine review stops entirely, because they discover a gap in structural documentation. These evidence gaps often show up as missing maker-checker signatures. Maker-checker is a basic control process where the person creating a transaction cannot be the same person who approves it, ensuring segregation of duties. When that signature is missing, the auditor's psychology changes immediately. What began as a standard randomized sample turns into a deep forensic investigation. This triggers cascading scrutiny. If one control point is bypassed, the entire network of financial data is vulnerable. One localized failure infects the perception of the entire ledger. A missing signature and cash approvals immediately casts doubt on related systems. To compensate for the broken trust, auditors demand deeper proof across the board. They will scrutinize the aging analysis of receivables and drill into the consistency of your inventory costing methods. The finance team freezes under this pressure because the numbers they forced together during the 30-day sprint have no historical backup to withstand the investigation. Weak documentation acts as a risk multiplier. It transforms routine balance checks into exhaustive, painful operational audits. To prevent this cascading failure, companies have to identify the internal warning signs long before the audit season begins. The most immediate red flag is the presence of unreconciled accounts, specifically items that have been left outstanding for 3 to 4 months, creating a backlog of hidden errors. This slide highlights where audit problems begin, specifically calling out unexplained suspense balances. These are temporary clearing accounts where funds are parked without the proper supporting documentation to classify them. Another critical danger zone is a GST turnover mismatch. GST, or Goods and Services Tax, is a domestic consumption tax, and if your internal financial statements don't perfectly align with the external tax returns you filed, regulators and auditors will intervene. The same scrutiny applies to TDS inconsistencies. TDS stands for Tax Deducted at Source, meaning taxes collected directly from the income-generating source. Any gap between the payments recorded in your ledger and the actual tax filings is a severe liability. These aged, unresolved differences sit quietly in the system all year, surfacing only when the auditor demands the evidence you never collected. These issues are not simple calculation errors. They are systemic control failures that demand architectural solutions, not quick spreadsheet fixes. Fixing systemic failures requires abandoning the sprint entirely and building a continuous readiness framework, whose operational cornerstone is the T+5 fast close cycle. T+5 means a finance team has the discipline to fully close their books exactly 5 business days after month end, completely eliminating any data lag. To hit that deadline, teams must implement a monthly reconciliation matrix to systematically track, verify, and lock down every single balance sheet account every 4 weeks. This creates a proactive barrier against errors, ensuring that internal financial turnover maps perfectly to external statutory filings without relying on guesswork. Securing the historical data allows the company to shift to forward-looking strategy, generating accurate rolling forecasts like a 13-week cash visibility report. None of this functions without heavily documented standard operating procedures to ensure that every analyst on the team executes these tasks exactly the same way every single day. A strict T+5 close physically prevents the accumulation of unresolved differences, neutralizing audit risks as a matter of daily routine. Ultimately, moving away from reactive accounting elevates a company to a state of true governance maturity. There is an unbreakable correlation in corporate finance. The internal strength of your controls dictates the external confidence of your auditors. Proactive issue management, built on rigorous variance tracking and complete transaction histories, drastically reduces the friction of the audit process. This document outlines what audit readiness actually delivers. By establishing financial reliability and tight risk controls, companies secure their capital and eliminate the threat of year-end adjustments. A clean, consistent audit history directly strengthens investor trust, proving the business has the structural integrity required to scale securely. Driving this shift in corporate culture requires an executive mindset that views data integrity as a non-negotiable asset. Audit readiness is never about impressing the people reviewing your books. It is a fundamental leadership discipline that protects the organization. Clean audits are not events you sprint toward at the end of the year. They are built daily through the quiet, consistent discipline of mature financial operations.